A very good morning to you. Thank you for joining us on the program. I am MPC Meeting. We start off with oil prices, which are a bit lower today as demand concerns stemming from surging coronavirus cases and renewed lockdowns in several countries kept gains. The likelihood of an effective COVID-19 vaccine and hopes that OPEC and its allies will keep production under check have bolstered the oil market this week. So let's look at the numbers now. Brent crude futures were down 0.1% to $44.17 a barrel in early trade. And then US WTI crude futures were seen down 0.31% at $41.61 a barrel. But despite these gains, these declines, both benchmarks are up over 3% so far this week, and that's the slimmest weekly gains that we've seen in the last 3 weeks. Oil prices were also supported by signs of movement on a stimulus deal in Washington. Now, one of the leading global ratings agencies, Moody's Investor Service, says that if the growth expansion witnessed in the manufacturing sector Purchasing Managers Index is sustained, Nigerian banks will see more positive credit ratings. Nigeria's manufacturing PMI hit 50.2 in November, halting a 6-month consecutive contraction owing to the impact of the coronavirus pandemic and the drop in crude oil prices. According to an analyst at Moody's, Peter Mushangwe, despite the greater economic activity signaling a positive trend, the rating agency still expects asset quality pressures in the system to persist. Now, the federal government this week had announced plans to offer more tax incentives to Nigerians through the forthcoming 2020 finance bill due to the current economic climate exacerbated by the devastating impact of the coronavirus pandemic. The Minister of Finance, Budget and National Planning, Zainab Ahmed, had explained that the incentives will include a reduction in duties on tractors, cars and trucks for conveying goods. But these proposals, according to her, captured in the 2020 Finance Bill President Buhari is about to transmit to the National Assembly for legislation. Well, joining me now to discuss and shed more light on these developments in line with the revenue drive of the federal government to fund the 2021 budget is an Associate Director at Anderson Tax, Michael Ango. Good morning, Mr. Ango. Thank you for joining us on the program. Now, how much of a relief will these proposed plans by the federal government provide to surmount the headwinds from the recent economic downturn and low revenue?
Good morning, BC. So first, before we discuss that, I think we should first commend the federal government for bringing out the bill in a timely manner. We've gotten the bill in November, and it's hoped that when it gets to the parliament, it will get attended to in due time to be passed before the start of the next fiscal year. In terms of the actual, waivers and incentives in the bill, I think the reality is that the government is caught between a rock and a hard place. And the reality is that government has seen its revenue drop significantly in the last 1 year due to a combination of factors. We had the COVID-19 crisis, of course, crude oil prices dropped. We've had protests in some of our major cities and all of that. So government revenue has significantly dropped. But here again, government is faced with the reality that it must stimulate business, it must stimulate economic activity in the economy so that people can begin to earn income and, of course, ultimately pay taxes to government. So in that regard, I think the idea of giving out the waivers is, it means by government to stimulate development or growth in certain areas. From where I sit, and this is me speaking as someone who is involved in taxation, I think the waivers are just enough in the sense that they are not as far as people would have wanted them to go. But you must also look at things from the perspective of government, that government cannot be seen to be giving out everything at this point in time. But I think for the issue of duty waivers, for example, on motor vehicles, on tractors, that is a very significant one. We've had duty waivers in import duty from 35% reduced down to 10% for vehicles used in movement of passengers and then goods. And for tractors, we've had it reduced from 35 to 5%. So that's a very significant drop. And what is expected is that, because there has been increase in in pump price of petroleum, that people will then, be able to use mass transit to move around our major cities. And so it is hoped that those who import these vehicles will then be able to import them and pay lower duty rates. For the tractors, it is understandable. One of the pillars of this government's economic development programs has been agric. So it is expected that if people can, import agricultural implements like tractors at very low duty rates, then this would also, impact their abilities to produce agric produce. There are other things, for example, like the reduction in the minimum tax rate. It's been reduced by 50%. So previously, the minimum tax rate was 0.5. It's now been reduced to 0.25. There's also been, for example, the, designation of animal feed as a basic food item under the Value Added Tax Act. So that is also very significant in the sense that persons who have previously been involved in production of animal feed have been agitating that animal feed should be designated as a basic food item. So to that extent, companies involved in production of animal feed and even users, poultries, people who are into livestock production and all that would I think, benefit to the extent that the exemption is on animal feed. So if you look at it holistically, you would say, yes, kudos to government. But as always, as the Oliver Twist that we tend to be, people might say that, look, the government could have done more. But like I earlier said, you have to also balance things. Government needs revenue for its programs. And so I think this is the extent that government will be able to go for the next fiscal year.
I'm glad you referred once again to the fact that government needs revenues. And when you look at this now, these incentives and waivers for companies now, how would it affect the revenue drive of the federal government when only months ago the president had complained about the inability of his government to generate the needed revenue to fund the budget?
Well, as someone who's not only been involved in tax consulting, I've also worked in government, on the revenue side. I can tell you that the revenue of government from the tax, from tax revenue is already impacted. Like I mentioned earlier, crude oil prices dropped significantly. And then, of course, economic activity slowed down with the lockdowns from March up to about maybe September, October, when the economy began to, kickstart. So government revenue is already impacted, and there's no hiding from that. Again, even for the next fiscal year, things like income tax is going to be significantly impacted because it is the economic activity that has gone on in this year that will, that will then create taxes on income that companies will be paying in the next tax filing period, which comes up in June. So the truth is that government revenue is already impacted. What is important is for government to put in initiatives that can quickly stimulate economic activity. How government is going to do that, again, is left to the economic experts. But what I know is that there are still, sectors of the economy that haven't been as impacted as others. So we know, for example, that during the lockdown, people had to resort to buying things, online and all that. So there's the idea that, digital businesses, online businesses saw a boost. Banking services too, people had to transact a lot of their activities offline. And online, rather, they couldn't walk into the banks and all of that, but people were at home. So the banks, it is believed that they made a lot of money from, bank charges and online transactions and all of that. So there's some sectors of the economy that maybe government would like to look very closely at and see if they can realize additional revenue from those sectors. But generally speaking, if you look at the economy as a whole, I do not think that there's a lot of room for government to, get additional tax revenue. What is important probably is for government to then be realistic in its revenue targets, to say, yes, because of what has happened in the last 12 months, etc., we have to put realistic targets for the next 1 year and then watch how it goes. But what is important is to also ensure that all the loopholes are closed. The new VAT of 7.5%, which is operational, should be collected. It should be implemented. I think that is an opportunity. The efforts to also realize the stamp duty in the economy is also an opportunity. So to that extent, yes, there's still room or there's opportunity. But I think any person who has been honest will tell you that government revenue is going to be significantly impacted for 2020 and probably into 2021.
Now, part of the finance bill adds that non-resident companies with significant economic presence in Nigeria into the tax net or will be dragged into the tax net. How can you give us a sense of how this works? How do you even truly define a company with significant economic presence?
Okay, the definition of significant economic presence has been set out in the significant economic presence order, which was issued by the minister. And there are a number of, parameters. The first, of course, is the income threshold. If you have an income threshold of 25 million naira or above, then, that is termed significant economic presence. If you provide certain services into Nigeria, if you provide your services in a certain way, if you use a Nigerian domain, you have a website, you have a www.ng website and all of that, you provide intermediation services and all. So there are clear rules for determining what significant economic presence is. The challenge with taxing companies in the digital economy is not so much in defining what they do, but is actually in capturing what they do within the Nigerian tax net. And I think that is one area, again, that maybe we need to encourage the Federal Ministry of Finance and the Federal Land Revenue Service to do some more public consultation and, of course, to bring in those persons who actually understand how that particular sector works. So one of the challenges, again, is that these companies do not have any physical presence in Nigeria. How do we begin to determine what they actually earn in Nigeria? I think to the extent that they transact business, to business, B2B, it might be easier. But when people, for example, individuals subscribe to some of these digital services, it is a lot much more difficult to be able to capture them within the Nigerian tax net. I see that there's been some effort in the finance bill, of course, to say that, for some of those who are involved in providing technical, professional, and management services, withholding tax, will be the final tax. In that sense, it's easier to implement. So what then happens is that if anyone, a non-resident company provides a technical service to myself or to you, we will then be responsible for deducting the withholding tax and remitting it. That is easier to implement. But then what happens if, for example, I subscribe to Netflix or to YouTube and any of these other platforms? An individual sitting down in Argungu or in Elisha or somewhere, how does the tax authority identify that particular transaction and bring it into the tax net? Now, in the Finance Bill 2020, or is it 2021, there has been a provision to say that the Federal Land Revenue Service can appoint a payment platform, a payment service provider or a payment gateway to be responsible for deducting such taxes. So I still feel that, there's need to really speak to the industry itself, speak to the industry operators, understand how this industry operates in terms of its payments, the transactions, and the agreements, so that government can then work out a proper template for taxing them. Otherwise, we'll continue to lose the opportunity to tax that particular sector of the economy, irrespective of all the rules that have been made. I mean, the reality is that rules are only as good as they are implemented. So if we have all the best rules to capture significant economic presence in Nigeria, but we don't have a proper implementation framework, then we may not be able to realize the value that we think we can from that particular sector.
Now, sometime in April this year, the federal government had opted for tax deferral rather than tax reduction, stating at the time that tax deduction might not really have the desired effect. So what could probably be the reason for the government U-turn, as it appears?
No, there hasn't really been a U-turn, sorry. There hasn't been a U-turn in the sense that it's not as if government has given a reduced taxes. What has happened is that the government has targeted specific areas. So just like we said, petrol price has gone up, cost of transportation within the country has gone up. People have said that one of the reasons why foodstuff prices have significantly increased in the last few months is because the cost of transportation has increased. So what government is saying is that we want to particularly target these areas and reduce the taxes or duties applicable to those areas. For things like the minimum tax, I think it's just a realization that if a company is already in a loss position and you're taxing, you're still insisting that the company should pay taxes, then you want to lessen the burden as significantly as possible. Okay, but generally speaking, I do not think that this particular finance bill is one that you can say is anchored on tax reductions, as it were. What you will say is that, yes, there has been some attempt to ensure that, burden of taxes or or duties, are reduced. But even if you quote what the Minister of Finance said in terms of the philosophy of the bill, she said that the bill had, I think, 5 thematic areas. First, she said, was fiscal and tax responsibility, enacting counter-cyclical measures and crisis intervention measures, procurement reforms, and, of course, ease of doing business. So you can see the major focus of the bill itself is not even in terms of tax reductions or tax waivers. But like I said, government is also trying to, be responsive so that it's not seen as though all it does is take. It's trying to say, okay, we've given you something back, but we all have to come together at this very difficult period in time and see how we can make, things improve. And hopefully we'll begin to see some improvement, in the next fiscal year in terms of both economic activity, tax revenue, and of course, implementation of the provisions of the finance bill when it's passed into law.
Now, let's talk about the role of investors now. Of course, still looking at the Finance Bill 2020, the president has said that there will be a bill to accompany every annual budget proposal. There's no reduction in value-added tax, of course, which is at 7.5%. But what signal does this send to investors?
Okay, I would say to you that overall, I think, again, even though I don't want to sound as if I'm giving the government too much kudos, but the fact that in the last 2 years, we've had government actually pass a finance bill along with the budget, I think is something that must be commendable. Previously, we haven't seen this. I think the last time we had the finance bill or decree was in 1996, prior to last year. So I think in terms of government trying to respond to developments annually by way of a finance bill, it is a positive one. Now, the contents of the bill is a different kettle of fish, but I think if I'm an investor, I'll be looking into the country economy and saying, well, at the very least, what happens in Nigeria is that annually there's some form of legislative response to economic development. And so that may give me some comfort to say, even if there's something that I disagree with in the law, or there's something that I find unfavorable to my business, I may just have to wait it out or sit it out for the next 12 months. And there's every chance that if the Finance Bill 2022 is passed, I can influence it, or at least I can get something in there. So to that extent, I think we're not sending a bad message out to investors. But I think anyone who expected a reduction in VAT in 2021, when we just increased VAT in 2020, would not have had a reasonable expectation. Like I said, government is out there looking for revenue. You and I know that government has had to leverage a lot of debt and all of that. So if there was sufficient, if government could get all the money it needed within this economy, it would have looked for it. But it has to, of course, to also, work with the realities on ground. So it is not, I don't think it was an expectation from any quarter that there will be a VAT reduction. But the message out there for investors, I think, is that we have a government that tries to respond to activities or to developments annually, and we do this by our finance bill. So if you're an investor and you think you have a significant concern about some tax or fiscal issue in Nigeria, what you may be thinking to yourself is, well, I have a 12-month cycle to do that. And so I think to that extent, we can commend the government for that. But now, again, maybe one thing that needs to be said is that there needs to be a bit more of public consultation. So even the current finance bill that is in circulation, we've only had about a week or two of public consultation. I would have preferred probably if government or the Ministry of Finance had done, maybe a 3-month cycle, had people, both consultants, people from manufacturing, aviation, all sectors look at this bill and say, look, this is where we think we have a problem. Can you try to accommodate what the concerns are for our own particular industry? And then have a holistic document that is then owned by everybody. Notwithstanding, I believe that there will be opportunities to discuss the bill further at the National Assembly when it's time for public hearing. And of course, I believe that the National Assembly will be responsive enough to listen to complaints or comments on the bill and probably incorporate them in the bill before it is passed into law.
We do appreciate your time. Associate Director at Anderson Tax, Mr. Michael Angle, thank you for sharing some of your time with us this morning.
Thank you, BC. It's a pleasure to be here.
The National Bureau of Statistics is expected to publish the GDP figures for the third quarter of the year next week. Nigeria's GDP growth was minus 6.1% in Q2 2020, ending the 3-year trend of positive but modest real GDP growth recorded since the second quarter of 2017. The Minister of Finance, Zainab Ahmed, had projected GDP growth to be negative in the third quarter, meaning the Nigerian economy is likely to lapse into a second recession in 4 years with significant adverse consequences. But the head research and strategy at Greenwich Merchant Bank, Ayodeji Ebo, joins us now for an outlook. Good morning, Ms. Ebo. Thank you for joining us on the program. So the GDP numbers are expected to be out next Monday. Are you predicting a recession? Let's bear in mind several negative projections that we've heard, including from the IMF and the World Bank.
Thank you for having me. I think if we look at the scenarios, looking at the second quarter, we all know because of the lockdown, a lot of the sectors closed in the red. But if we now look at what has happened between July and September, within that period, we saw the reopening of the domestic airport, we saw the reopening of the international airports, and also movement, and most businesses also improved. Looking at oil prices too, if we look at the average in the second quarter was around maybe $30, and comparing it to around over $40 per barrel in the third quarter. Notwithstanding, we still expect that there will be an improvement, however, still in the negative region, maybe between the 4 to 5% negative region. And the major drawbacks to some of the major sectors that should trigger this growth, if you look at the manufacturing sector, for a lot of within that space, which is a major employer of labor, most of them are still trying to balance from that supply disruptions, and that's also impacted on businesses. Also trade, we're all aware of the FX liquidity that has also impacted on trade. So by and large, if you look at most of the subsectors, will still, there will be some improvement, but will still close in the red. So, and for us to be technically in recession, you record 2 consecutive negative growth rates. So technically, based on what has happened between July and September, based on estimation, we're expecting that Nigeria will still close in the red, which would will formally be in recession, another recession in about 4 years.
Now, what if you take into perspective the NSAS protest and even the aftermath of the protests now? What do you think, or what impact do you expect this to have?
Okay, interestingly, it means we are talking about what we should expect in the fourth quarter, because the NSAS protests happened last month, and that is like a major drag on the economy. We're still in a very fragile state, trying to crawl back to that positive region. And if you take, for instance, the manufacturing sector, looking at the PMI data that tracks the activity within that space, you would see that there've been some form of improvement, though in the contraction region. However, we saw that movement for the first time since April to the expansion region, about 50 points. So we feel that the NSAS protests would be a major drag and would impact on the expectation of Nigeria recovering in the fourth quarter of 2020.
Now, when we look at last quarter's figures now, the main sector contributors to the GDP growth all settled in the negative territory, from oil refining to trade to manufacturing and even the severely battered services sector. However, when we see sectors like the ICT and the financial and insurance, they witness significant advances of 15.09% and 28.41% respectively. So what do you think is key to Nigeria's recovery, and what sectors hold growth opportunities?
Okay, thanks. I think I would like to look at it like this. What are those sectors that can help increase or can generate more jobs, and also their contribution to GDP. So if we start with looking at we know the agri space, still closed in the positive region even for last quarter, and there's been a lot of effort there to ramp up production. But a major dent that we saw there was the flooding that would also affect harvesting because of the flooding within the northern region. Then if we also want to look at that second prominent sector that we should look out for is manufacturing, because of the ability to generate employment. We need to come up with strategies and policies that would help reduce the burden. We've seen for most of the fast-moving consumer goods, they've been able to increase prices. They've been able to pass major costs to the consumers. But what that does is also reduces the purchasing power of the individual, which we can track from looking at the inflation rate. We can see that increase in prices of the goods. Lastly, I would like to touch on trade. It's also a major employer of labor, but we all know the bottlenecks or the constraint that sector is experiencing, and that will have a major impact on the growth of also the economy, looking at their contribution also to GDP. So by and large, I think it's more of trying to focus. We've been able to identifying those prominent or priority sectors, and what are those things that do we need to do to unlock those sectors? Do it support in terms of infrastructure, support in terms of power, and we also look at policies around those places that will bring confidence for most people to expand. If you recall, we're looking at that's the African Continental Free Trade Zone taking off in 2021. How are we preparing our manufacturing companies for them to be able to position and take advantage of that, to be able to export to some of these countries? So these are some of the focus that I think we need to begin to look at now and focus more on now, which would generate employment. And we know the correlation between employment and security. We know that it's really very strong. So the more we're able to generate more employment, it would also bring down the insecurity we have in the country, and we'll be able to attract more investment into the country.
Now, let's dwell more on the manufacturing sector that you've touched on. Now, of course, you would agree that we have not actually fared well in that aspect. But do you think that an industrial plan will quicken the pace of an economic development in Nigeria?
Yes, very interesting question you have raised. Like I was talking about the manufacturing sector, we need to have that deliberate developmental plan. What do we need to do to increase manufacturing? What do we need to do to create an enabling environment such that most of the production, most of these products from these companies will be competitive? Cost of production, we know cost of energy has continued to increase, both looking at PMS and also the electricity tariff. That will impact on the manufacturing companies. When you look at to dissect manufacturing companies, the SMEs account for a major, close to 90% of that sector. So what do we need to do to continue to support them? I know government, from the fiscal angle, also from the monetary angle, there are intervention funds that have been set to support. But when you look at the quantum of those intervention funds relative to the size of that sector, is still very minute. So it means government is limited in terms of what it can provide. Now, what will be the next step is to look at what the private sector, what can they do for us to be able to fast track in providing the distribution network, in providing the electricity. We need the private sector to come in. But before they will also come in, they need that confidence, they need that assurance that their investment will be protected over time. So it's very important that we come up with that long-term developmental program that we can begin to measure, we can begin to implement over time. And once we begin to see that impact over time, that would also be a major boost for potential investors into that sector.
All right, now let's touch on the MPC meeting of the central bank, which is scheduled for next week as well. Of course, it's the last meeting for the year. Are you expecting any major surprises?
Yeah. Yes, looking at the last MPC meeting in September, we saw that it was a major surprise to see that rate cut from 12.5% to 11.5%. But what that did was that provided some clearer guidance into what the stance of the MPC member or the CBN is. So we're all aware that, or we all got to know that this low rate interest rate environment is expected to stay longer than anticipated. We feel that at this meeting, the MPC would want to still give time to see how that the rate cut at the last MPC meeting and the increased adjustment in asymmetric corridor, how it has transmitted into growth, how it has transmitted into lending. So we expect that they would hold rates at current levels while giving more time for them to see how those things transmit into lending. Looking at within that period, if you look at the maximum lending rate, it's remained sticky downwards, still currently around 29%, based on CBN data. But we've seen that moderation in the prime lending rate. That's the lending rate to the premium guys. So we've seen that moderation to a single-digit level. But looking at the interest rate environment at very low rates now, what would see is that the private sector would begin to take advantage of that to raise funds at even rates that are lower than the CBN intervention rates, which we feel is also positive in the medium to long term for these companies.
Now, are there any external events that you see the members leveraging to arrive at their decisions at this time? Talking about events like the COVID-19 second wave and the vaccines, the U.S. election and Iran's nuclear deal, which could ultimately see increased crude oil supply from Iran?
Interesting. That's a cocktail of events to consider. If you look at what I think the focus would be, we know how dependent dependent on oil we are. Based on the stance of the OPEC Plus and OPEC members, they are trying to keep the oil price above the $40 benchmark, so thereby adjusting output to achieve that. So we feel that if that can remain above the budget benchmark of $40 per barrel, the election in the U.S., which we are still awaiting the announcement of the winner of that election. You spoke about the second wave of COVID-19, but also the vaccine, discovery of vaccine, which is above, most of them are above 90% effective level, is also a major sign of relief. So since there's still a lot of things happening at the same time, and still want to give maybe more time till January before they make any major moves on the interest rate. What the focus may also need to be is on the pressure we're seeing on the parallel market. So we've seen exchange rate move from about 470 within the last 2 weeks to almost 480 as of yesterday. So that will be a major concern. And we're expecting that maybe there will be more policy around reducing the usage of FX for some material or some items rather, and that we feel that would also channel more pressure to the parallel market. It's more of with a supply. We need more supply at both the investors and exporters window, as well as the CBN. CBN is trying its best, trying to see how they can manage the exchange rates to at least weather the storm and see whether oil price will improve in the nearest term for them to be able to have more buffers to defend the naira.
Right. Head Research and Strategy at Greenwich Merchant Bank, Ayodeji Ebo, thank you for speaking with us this morning.
Thank you for having me.
All right, now it's time to cross to the markets with a quick recap of yesterday's trading at the NSE, where the bears returned following profit taking on banking stocks like Zenith Bank, Stanbic IBTC and UBA, and that led to a 0.5% drop in the benchmark index. Total volume traded was down 44.8% to 364.9 million units, and that was valued at 3.5 billion naira, and exchanged in 6,340 deals. Now, Transcore was the most traded stock by volume at 50.7 million units, while Zenith Bank was the most traded stock by value at 535.68 million. Sectorally, the performance was mixed following gains in the insurance, consumer goods and industrial goods indices and a loss in the banking index. The oil and gas index closed flat. We'll look at market sentiment now as measured by market breadth. That was negative. We had 19 gainers relative to 28 losers. Well, the chief dealer at Citico Trust and Investment Company, Mr. Charles Fakruga, joins us now for a review and outlook for today's session. Good morning, Mr. Fakruga. Thank you for joining us. Now, let me begin with this now. Tier 1 lender GT Bank yesterday reported a slightly disappointing performance in its group 9 months financial results as at September the 30th, and that was just as Sterling Bank also posted a lackluster performance in its group performance within the third quarter of the year. Now, how are you digesting these numbers?
Yes, you will recall that the earnings that they are sending to the market now, Q3, we are seeing some of these shortfalls. What can be attributed to the challenges they've encountered throughout this year as a result of the pandemic, and of course, at the same time, their source of income, mainly interest, has also gone down. So, but basically, it's just the challenges, the pandemic that most of these lenders are experiencing. That's why we are seeing their earnings reducing.
So are we likely to see the bearish trend continue at the markets today?
Yes, right now, as we will speak, the market is already down. I see the bearish trends to continue. The bears will try and make a strong comeback. But for investors who are for long term, medium term, I'm still bullish about that. I'll just encourage them to still remain resilient. In the market, you must have profit taking, and if we see all the increases last week and this particular week, you will know that yes, short-term investors want to take profit, so it's not unexpected.
So are we likely to see the profit taking extend into the coming week?
Yeah, like I said, I still see the market bearish in the coming week. But for investors who are medium to long term, I am bullish about it. I will just encourage them to continue to remain in the market, but at the same time, invest in companies with strong fundamentals.
Chief Dealer at Citico Trust and Investment Company, Mr. Charles Fakruga, thank you for your time. It will be time to touch base with London when we return in just a moment. Don't go away. Juliana Olayinka joins us now from our London studio to discuss this morning's headlines coming from the UK. Good morning, Juliana. Nearly 200 charities and aid organizations have called on Boris Johnson to reconsider plans to cut billions from the international development budget by reducing it to 0.5% of the GDP. Now, can you shed more light on their requirements?
Oh, well, yes. Well, the requirement is basically not to make the cut. I believe the 0.7% that Britain have put into legislation, so they're legally binded to do so, amounts to about £13.4 billion every year. They've been doing it since they became a donor nation in the 1970s, but they've been doing it religiously for about 5 years now, and it's always been a pretty controversial topic here in Britain, because some would say 0.7% is nothing, it's a drop in the ocean, but when you think of how much billions that amounts to, there are cause for concern. Household names including Save the Children, Greenpeace, UNICEF, Friends of the Earth, they've written an open letter to Prime Minister Boris Johnson basically saying that if they do decide next week to reduce the spend to 0.5%, that will really take a shot at Britain's global standing in the world. Of course, we're suffering a global pandemic. There are vaccine hopes. A vaccine isn't going to likely get to the people who need it most, particularly in developing nations. And there have been concerns from the United Nations that the COVID-19 crisis has pushed about 115 million people into extreme poverty. So at the time, those who need it the most should be getting this aid. They potentially won't be getting it. Just so you know, Pakistan, Syria, Ethiopia, Nigeria, which surprised me, and Afghanistan are the top 5 countries that receive aid. And again, going back to the controversy, there have been so many reports about money that has been mismanaged, some reports and suggestions that some of this money has been ending up in overseas bank accounts in Panama and Switzerland. So when it is announced next week, unfortunately, it is unlikely to raise eyebrows in the House of Commons, because I think people in Britain want money spent in Britain.
I can only imagine, Juliana. Meanwhile, Chancellor Rishi Sunak is preparing to announce a renewed squeeze on public sector pay in next week's government spending review, and that's in response to the economic shock of the coronavirus pandemic. What sort of reactions are we likely to see arising from this announcement?
Well, two terms come to mind, backlash and fury, particularly from unions who have always felt that public sector workers have always had the lion's share of austerity cuts from the Conservative government over the years. And this is really bad timing, I've got to say, for Chancellor Rishi Sunak. Of course, the one-year spending review was always in the calendar, as that was coming up next week anyway. But to decide to put a pay freeze on the public sector is going to cause a complete firestorm. I believe so far, according to sources, that it will not affect frontline nurses and doctors who have been obviously on the battleground trying to tackle COVID-19, but it will affect other people who work within the NHS, including cleaners, including management. It would also affect police officers, members of the armed forces, teachers, people who have, done their fair share over the past couple of months. But the Chancellor does feel as if perhaps this pay freeze, which I think is going to save about £20 billion a year, will help fill up the coffers. And of course, those coffers have been completely raided because we've been trying to get through this COVID-19 crisis that's completely crippled Britain's economy, that is in a paralysis at the moment because we're in a lockdown.
Now, the EU's chief negotiator, Michel Barnier, has been forced to go into self-isolation, and face-to-face Brexit talks in Brussels have been suspended after a member of the bloc's negotiating team tested positive for COVID-19. How much of pressure will this put on the already tight timeline on the trade talks?
Gosh, you can imagine this is absolutely chaotic. I think chaos has been a theme word for Brexit talks this year. And again, it's chaotic again. But, I've got to say the British side, Downing Street in particular, are saying that things will be fine, that talks will continue this morning, I believe, via video conference call. But it's just not the same. Michel Barnier yesterday made the announcement that a member of his negotiating team has tested positive for COVID-19. According to Belgian health restrictions, he has to go into self-isolation now for about a week. He obviously, quite famously, was one of the first global diplomats to catch COVID-19 back in March. So, yes, it's not great. We were told that we should be expecting an announcement on negotiations by the end of this weekend. That actually pushed up sterling at the beginning of the week because there are hopes that there could potentially be a deal. But of course, this has set things back because if you're not face to face with somebody, those tough negotiations are a little bit more difficult to try and ratify, especially as there are only 6 weeks or so left towards the end of the year.
Just before you go, Juliana, the Queen and Duke of Edinburgh are celebrating the 73rd wedding anniversary today. Will there be any celebrations or COVID-19 is having an effect?
Yes, the Queen Elizabeth II and Prince Philip, they are celebrating their 73rd wedding anniversary today. It is going to be a low-key affair, of course, because we're in the middle of a pandemic and in the middle of a lockdown here in England. They have been spending their lockdown in Windsor Castle in England, but they have released a really lovely picture. It's a shame we can't show you of them looking at a 73rd anniversary card, which was sent to them by the Duke and Duchess of Cambridge, or Prince William's children, Prince George, Prince Louis and Prince Charlotte, which was quite sweet. They married in the early 40s on the 20th of November, and I believe, if I'm right, that this is the longest marriage of any serving British monarch in history. So happy anniversary to them.
Absolutely. We'll say congratulations to them. Thank you, Juliana. We'll see you again in the afternoon. All right, let's bring things back home now. And Bemi Arumire comes in, who's a fixed income trader at UBA, to do a review of the fixed income market. Good morning. Now, can you give us an overview of yesterday's activities at the fixed income space and what to expect today?
Good morning. Thank you for having me. So activities at the fixed income market remained relatively calm. There was an OMO auction which took place yesterday, where we saw yields continue to trend lower at across all the three maturities that was offered. On Tuesday, we had seen a tune of 281 billion, which matured into the system. A bit of this had gone into the bond auction, which had come in the week, and we saw the rest of it at for investors coming in at the OMO auction. So we had 90 billion, which was on offer, 70 billion on the long end, and 10 billion on the short and medium end of the curve. We saw rates drop to 6% levels, and the other two dropped significantly lower. At the NTD space of the market traded on a low note, as we saw yields drop to 0.13 on the long end of maturities at the secondary market. While we saw on the bond space, we saw slight bullish action as we saw some participants coming to cherry pick based on their sentiments after the auction. A lot of what has shaped this week has been the bond auction, which took place on Wednesday, where we saw 80 billion on offer. And it was interesting to see the yield at which participants came at. We saw yields as low as 3.15 at the 2035, while we saw yields as low as 3.95% coming to the auction. This, judging from this rate, it shows that participants' sentiments to what they expect coming in for the rest of the year shows that it's mixed, because we also saw yields as high as 90% coming into that auction. So we see some people expecting the DMO's rate to reverse anytime soon, while we also saw that there were a lot of people who were still desperate to keep their idle funds in one security before the end of the year. But judging from the DMO, we've seen that this low-rate regime might continue till year-end.
All right, I'd like to thank you, fixed income trader at UBA, Gbemisola Bello Arumire. Enjoy the rest of your day. And that's our program today and for the week. Thank you for watching. I am MPC Adebayo. See you next time.